All right, so where are we at in terms of the cycle? I love this bit of data that we get supplied from our good friends again at CoreLogic. We can see here that when we break the markets down into their quartiles, so 20 quadrants, 25th% quadrant, 50% quadrant, 70% quadrant. So that's where the price activity is happening. So we can normally say in a cycle that a usual up cycle, the part of a new cycle, is where the higher end, the 75% quartile, where the values are growing first. That basically is not a bad indicator. It's not perfectly reliable, but it's not a bad indicator that that's in a new part of a cycle, and eventually that will flow through to the rest of the market. What is skewing this data, however, and I've got to flag this again, is APRA's throttle. Their 3% buffer rates means that in a lot of cases, a lot of people are being forced into the middle or lower quartiles, especially the investors, and that's potentially putting pressure on those markets. And that's why we're also seeing strong price growth across those particular markets. But
I think that's
if
a
you
very
look at,
important point, Ben, too, because if you have a look across this chart, and for those just listening, with the exception of Darwin and the ACT, all of that first quartile is in the positive, and it's if you're largely systemically being forced into that particular market because of that APRA throttle that you talked about,
yeah,
it kind of makes sense. But in the majority of the markets, just having a quick look, that lower quartile is the strongest quartile, so it kind of makes sense that's where the demand is.
yeah, and I think it makes a good point. So what we've then got to say to ourselves is that meaning that the cycle is slowing down, or it's because of the macro intervention that that's happening that's causing that. Because you can also see where Darwin and the ACT, if it's true to historical form and there's no market manipulation, what's happening with APRA, then you would say, as I said, it's a pretty good indicator that the ACT with their highest quartile leading and the mid quartile, that's how that ripple effect will happen. So we talk about ripple effects from the most expensive land and property locations, and then the ripple affecting in terms of affordability pushes everyone out into those other areas. And so that's starting in ACT, it's starting in Darwin in terms of that. And you can see the other side of that is the back end of the cycle, which Hobart's going through right now, which is the 1.3% down the 9. So and only the lower quartiles just got a sneaky little 0.1% growth. So you'd think that that's at the tail end of its down cycle, or there might be still something to go, but there's no green shoots in that particular market. And similar to Melbourne, there's no immediate green shoots in that particular market. I've been studying sort of some of my local area recently, and I was saying this comment to you before we started recording, Bryce, that the really, really high value properties, those status properties, they are still selling very, very well. But it's the second tier and third tier or compromised properties or tired properties that are taking longer to sell. And the seller has to meet the market on those types of properties. And so we're starting to see more of that sort of B grade and D grade type properties in the market still, and that's also affecting those values. So, and that sort of fleshes itself out as part of that cycle until we get a kicker, which is that interest rate story that we were talking before about. So, quite an interesting sort of look at that market. All right, let's move along now and sort of talk about rental demand. So we can see here in terms of, the rental demand story across the different states and territories, we can see, what's been basically happening here is a story of, annual change in rents. We can see a mixed bag there, but predominantly very, very strong results except for Hobart and Canberra. And then, that was in January. And now we see, this July story, really only regional. Northern Territory has been, everyone else is showing really positive stories, again, off the back of those higher costs, but also the ability to be able to pass those rents on because of the tight rental market that we're currently seeing as well. So you've got Perth as the best market in the country, followed closely by Adelaide and Melbourne as those two, those strongest rental growth markets. And we talked before about that student accommodation story being a real problem. Let's take a look at the overall sort of monthly change in rental dwelling. So there it is. That's telling you that story. In the last month alone, you've got Melbourne still growing at 0.3, Adelaide growing at 0.6, and Perth growing at 0.3. And then you've got Sydney coming off by 0.1, Brisbane coming up by 0.1, Hobart coming off by 0.3, and the other market of Darwin and Canberra flat. And then the regional story, some positive stories there for growth on all of the regional areas except for regional Tassie, which has come off negative 0.2 as part of that story. When we then start to look at those rental yields, quick assessment of that rental yield story. What we're seeing here in the rental yield story is that as values go, we talked about this before, as values go down, rental yields look better. As values go up, rental yields look worse. But more broadly, in terms of, that's why I'm always not looking so much at rental yield percentages. I'm always looking at change of rent. And when I'm doing a rental analysis, I'm looking at are the rents going up higher based on market forces as opposed to the rental yields are going down based on price movement, is always a good way of looking at that particular story.